Hello everyone, my name is Paul Dell, I'm a partner here at Raffingers, and welcome to the episode 4 of our series Securing Your Financial Future. Today we're going to be looking at the basics of inheritance tax. As Benjamin Franklin famously said, there's nothing more certain in life than death and taxes, and inheritance tax, IHT as it's known, is where these two collide. Some would say it's a very unfair tax because wealth is built up from taxed income over the years, and then on death they grab another slice of the action. With early planning there are ways to mitigate it, and in this episode we're just going to look at the basic outline of the rules, and then in the next episode we'll follow up some more advanced planning products and tax efficient investments, etc., that are around to assist in the mitigation process. Inheritance tax is a tax paid on the value of your estate on death. Everybody gets a nil rate band of $325,000, and basically anything over and above that is taxed at 40%, so quite penal. Unfortunately, no. Most people in the southeast will have a problem because their property values will take them well over the nil rate band, and so they need to be looking at this early doors to do the planning they can to make sure that HMRC are not one of the biggest beneficiaries of the estate. So IHT is paid by pretty much anyone who's UK domiciled. Domicile is quite a complicated concept, but basically if your origins are in the UK, you were born in the UK, then you're going to be liable to inheritance tax on your worldwide assets.
IHT is paid on death. There's certain lifetime transfers which we will cover in the next episode when it's payable. And that is basically the 2 times it is payable.
So when you have, obviously when you die and the value of your estate is calculated, that will include everything. So people think that their house isn't included, but it is. It's the value of all the cash you have in the bank, and there are certain things that are exempt from the calculation, such as your pensions. But outside of that, everything is added together. A value is performed, produced on that amount, and then at that point in time, the calculations begin in terms of filing for HMRC to calculate how much IHT will be payable.
So on death, the rate of IHT that people will pay is 40% over and above their nil rate band. There is a main residence relief that was introduced a few years ago by government, which could take the nil rate band up by a further $175,000. There are transferable nil rate bands as well from if you have a deceased spouse, but it's quite a complicated area. But basically anything over and above your nil rate bands is going to be taxed at 40%.
As soon as you know you're going to have a liability, really would be a good time to start to think about it. If some people accumulate vast amounts of wealth very early in their lives, they're very fortunate. Others, it tends to be, for most of us, it tends to be later on in life when you're at the peak of your career and you've paid off your debts and you have the opportunity to invest. But as soon as you know there's going to be a liability, I think you can start to consider some planning strategies. Gifting, like Andrew said. Every 7 years it would fall out of the estate. So if you think about it, if you had enough money to be considering making multiple gifts to multiple people, your children or whatever, you might need 14 years, 21 years. So, a long period of time for those strategies. So I would say as soon as you're going to have a liability would be a good time to start.
Well, I think the first question you ask any client, have they got an up-to-date will? You'll be surprised how many clients do not. That is the first point of planning. The second point of planning is really ascertaining what the value of one's estate is and what assets within the estate are liable to inheritance tax, because until you understand what a person is worth and what assets are liable to inheritance tax, what planning do you do? There's a number of exemptions you can take advantage of. You can make annual gifts each year of £3,000 a year. Again, when you're looking at large sums and IHT planning, £3,000 gifts aren't really going to make a huge amount of difference. You can gift assets away in your lifetime. Generally, most gifts are what we call potentially exempt transfers. What that basically means is it takes 7 years for that gift to fall outside of your estate for inheritance tax purposes. You can make chargeable lifetime transfers into various trust arrangements, and I will cover those in more detail in a following episode when we look at ways to mitigate IHT and to plan for IHT. Anything else? You can look at other IHT friendly investments. As Lawrence mentioned a little while ago, there are a number of investments, or when you look at the value of one's estate, you look at the value that is liable to inheritance tax, but there's a number of investments that, once invested in for a certain period of time, will not form part of the value of your estate for IHT purposes. And as I mentioned previously, I'll cover that in a bit more detail in the following episode.
Another thing I would point out is one of the easiest ways to cover the IHT is, once you've worked out what your potential liability is just to maybe look at some life assurance as a quick fix to cover the IHT payable.
Yeah.
But as you can see from this, it's quite a complicated area, and this is only the basics we're covering here. So again, the key is to take advice for your individual circumstances. So if you're interested in taking this further, then give us a call here at Raffingers, and we'll be pleased to advise.